And welcome back once again. Good morning, everybody. Hello to all of our new options traders out there. I know we've got a few who have joined here. It's great having you here. And today I wanted to continue with some more idiotic ideas. We're up to number 10, the put advantage. Now, quick little reminder for people who might have forgotten, or if you're brand new to this series, I got these from a book that I happened to buy. It's just absolutely loaded with ridiculously dumb ideas. And my point is not to really bash the book, even though it's very easy to do. I'm not going to name the author or the title because my bigger point is to show you why it's so important that you get good education and a good solid foundation. Because this person holds himself out as a professional, used to run a newsletter, talks about all the money he made and how he's such a great professional trader. But when you read the book, you just realize there's no possible way that could be true. He is just out in left field. And if you don't know what you don't know, sure, you could read this book and say, oh, these are wonderful ideas. So let's go take a look at idiotic ideas number 10, the put advantage. What is this one about? Well, before we get started, remember, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So here's a direct quote from the book. And he says, when stocks rise in price, it is like climbing the steps of the Empire State Building. But when they fall, it is like jumping off the Empire State Building. Stock prices fall much more sharply than they rise, and that is what you are betting on, violent price action. Consequently, puts give you more bang for your buck. Okay, so I've highlighted this more bang for your buck because I've talked about this so many times in previous videos. Remember, you must always pay for an advantage in the markets. So if it's really true that you get some type of an advantage by using puts, well, everybody figures that out and you're going to have to pay for it. And if you pay for it, that negates the advantage. And this is precisely why in the markets we see skews. All right, so we've talked about these before, but remember what a skew is. If we have strikes across the bottom and we have implied volatilities on the vertical, we can do a layout, and a lot of brokers' platforms will show this to you, but let's say the stock is trading for 100. All of your strikes below would be the out-of-the-money puts, and all of the strikes above, on this side of the chart, would be the out-of-the-money calls. So we're plotting calls and puts. Now, theoretically, if the stock is trading at 20% volatility, every single strike should be trading at that volatility. It makes sense because they're all the same expiration on the same underlying stock. So you would think that you would get this flat line. And that's what Black-Scholes assumed when they built the Black-Scholes pricing model. But in the real world, we don't get that. We get stuff like this, sometimes called a volatility smile. And so it looks more like this U shape. And so notice that we get these wings out here pushed higher than what you would expect. And the reason for this is because, largely of the crash of '87, traders recognized that, yes, stocks can fall much faster than they rise. But this is why people pay for that. So if you're paying for that benefit, it's gone. And in most cases, when it comes to puts, especially with the out of the monies, you are overpaying for them. So just to come up with this premise that stocks fall harder than they rise, therefore you're better off with puts, is absolutely completely ignorant to how options work. Now there's a second part in the same little section in the book, and he says there is also another advantage. Puts are usually cheaper than calls. This is due to the fact that puts and calls are priced based on the cost of holding the underlying position, and a call is a surrogate for the stock. Owning a stock is more expensive than shorting a stock, the purpose of a put. So he's saying that that's really the reason for buying a put is as a substitute for shorting the stock. But if you're going to buy a call, you have to pay for the cost of carry. And he says, look at that. Stocks fall faster and harder than they rise, but you're also getting it at a huge discount because puts are cheaper than calls. Well, let's find out how he could make such a bad mistake. So here's an example. Let's say the stock is trading for 100. Interest rates, I'm just going to make 10% just to highlight the differences, to really push a difference in them. Days to expiration, 1 year, 365 days. And a pricing model would say that the $100 call is worth $13.27. and the $100 put would be worth $375. And so this is what he's looking at. He says, look at this. Calls are so much more expensive than puts. And that's because of this idea of cost of carry. But what he's not realizing is that that is all factored in. So remember, we've talked about this before. The price of the option is not necessarily the price that you're seeing. We have to subtract out intrinsic value. And for the calls, we have to back out the cost of carry. The price of the option is the volatility value. And so that can be a little difficult to see. But as I'm going to show, these prices are actually the same. So for example, those are the prices that we just saw. Now we have to do what's called the present value of the exercise price. And that just means we know that in the future we would have to spend $100 for that strike price, but that's in 1 year. That's assuming we want to exercise this call. So in the Black-Scholes world and in a lot of areas of finance, they work with this exponential function, this little letter E. Many of you might have seen in math classes and finance classes, but it's just the present value of the stock. We're just using continuous compounding. But just think of it as saying, what's the amount of money we would need today to have this grow to $100 in 1 year? So if we take this little exponential function to minus 10% interest, that's discounting it, that's why we have a minus sign, we come up with 0.9048. And so that's our discounting factor. So we take the $100 stock times this factor equals $90.48. And if we subtract this from the $100 stock price, that's the minimum price that a call could ever trade for. Otherwise, there's what's called an arbitrage opportunity. So check this out. We have the call's minimum price is the $100 stock minus the present value of the exercise price equals $9.52. So the bare bones minimum that this call could ever trade for is $9.52. And we see it's being priced at $13.27. So there's a little bit of a premium over and above $9.52. How much? Well, let's take the $13.27 minus $9.52. It's $3.75, exactly the price of the put. So the volatility value that you're paying for the call is 100% identical to that of the put. So where he's getting this idea that puts are cheaper is just simply not true. So if we come back and we compare these, we can look at a synthetic combination. We've talked about synthetics before. Remember that the combination of stock plus a put is exactly the same thing as holding a call plus a bond. A bond, let's say, being a T-bill that's equal to the present value of that exercise price. In other words, if we deposit enough money so that it grows at the risk-free rate to equal that strike price, and we buy the call, that would be exactly the same thing, financially speaking, as somebody who buys the stock in the put. So let's go back to these calculations. The $100 stock price discounted again was $90.48. So if we deposit $90.48 into a risk-free account, that's going to grow to $100 in 1 year, which means we would have exactly the amount to exercise that call. Remember, it's a $100 call. So we would have to deposit $90.48 today, but we also have to deposit $13.27 to buy the call. So we need to deposit $103.75. And so here we are with our account. We just drop in $103.75, but we buy the call for $13.27. We're left with $90.48, and of course that's going to grow to the $100 strike. And so in the future, in 1 year, and if the stock is below the put strike, the person will exercise and have no shares. But if the stock is above the put strike, he'll just let the put expire worthless and he'll be long shares of stock. So take a look at the right side. If we have the call plus the bond, if the stock price tanks, we'll just hold the bond. We will have the $100 cash, exactly what this person would have if the stock price falls. He's going to exercise and get the $100 cash by receiving that $100 strike from the put. But if the stock price rises above that strike, we're going to exercise. We'll pay the $100 to exercise the call, and we will be long shares of stock exactly like the trader on the left. They're just two different ways of accomplishing the same thing. So the point to see is that if we have these two prices, you might be looking, let's say, on your broker's platform, and it's very easy to say, oh, calls are so much more expensive than puts. But once you understand what you're looking at, these prices right here are exactly the same. And so for this author to say that these are two different prices and that calls are more expensive than puts for this reason is just an idiotic idea. Always remember that successful options trading relies on finding apparent pricing discrepancies. So if you were to see this call and put as different prices, you're not understanding option pricing. And if you don't understand how options are priced, you can't possibly know how to trade pricing discrepancies. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on the YouTube channel Options A to Z's Facebook trading group, where you can find all of the archive videos from our trading forum. And you can find a link in the description below.